Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this stock market update and industry sector review for the week ending Friday, July 13th, 2018. Before I jump into the charts and commentary, I would like to begin with the quote of the week. And this week's quote is from Ayn Rand. She was an amazing author, and one of my favorite books is Atlas Shrugged. It is one of the greatest books ever written. Ayn Rand once said, "The question isn't who is going to let me, it is who is going to stop me." Those are some very wise words and motivating words from Ayn Rand. Well, the volatility continues. We had a post 4th of July rally in the Dow, S&P, and Nasdaq, and then they kind of hit a brick wall when they reached those highs that I set out in prior videos. We hit the June and February highs and March highs and slammed into it and turned right back down pretty hard on Wednesday when the Trump administration announced possible plans to implement another $200 billion worth of tariffs against imported Chinese goods. The global stock markets didn't like it. Not sure if it means a downtrend is coming, but Wednesday was a pretty weak day for many asset classes. So we'll take it one day at a time. And let's just go right ahead and jump into the charts, beginning with the Dow Jones Industrial Average. Looking at this chart of the Dow Jones Industrial Average, you can see that we had this nice post-Independence Day rally that began on July 3rd and then really started taking off on the 5th and then ended up peaking on July 10th. And on the 11th, we had that 200-point down day on the Dow. So right now, the 5-day moving average in red is now back basically close enough to say it's on top of the 20-day moving average and the 50-day moving average. And all three are basically right on top of each other. So there is tremendous amount of indecision. And you can see in this chart that the Dow Jones Industrial Average has gone nowhere since the 2nd of February. Lots of volatility, lots of choppiness in here. But if I draw a line showing the resistance levels of this Dow Jones Industrial Average, you can see where we ended up leveling off. The high of July 10th matched up with the high of May 23rd and May 14th, and all the way back here on March 16th, and these dates here on March 5th and 6th, and also this high back here on February 6th. So there still is a tremendous amount of overhead resistance for the Dow Jones Industrial Average, and so much resistance that the blue 20-day moving average right here has now crossed back below the 50-day moving average in purple as of July 9th. So we have an intermediate term weakness confirmation, which is not a good sign for the Dow Jones. And I would just highly recommend using caution right now until we have some further clarity, because this is just a choppy, volatile mess of a stock index. So yeah, use caution on the Dow Jones Industrial Average at this time. In this chart of the S&P 500, you can see that the rally that began on July 3rd peaked out on July 10th and then fell on the 11th of July. And as I had mentioned earlier, this particular index hit a ceiling when it contacted the highs of the 13th of June and the 12th of March, as well as the 27th of February. We rallied up, hit it, failed, and we rallied up and broke it this past week, and then we failed again on the 11th of July. So right now, this S&P 500 is looking very conflicted. The 5-day moving average in red here is back above the 20 and the 50-day moving averages, giving it a sign of short-term strength. However, the 20-day moving average in blue and the 50-day moving average in purple are converging on each other, but we still have intermediate term strength in this chart. So right now we have short-term strength and intermediate term strength, but we now have 4 occurrences where we hit the same price point and it has failed every time. So be very cautious with the S&P 500 until we get some further clarity and a breakout above that horizontal red line, which is representing the resistance for the S&P 500 that it has not broken above at all since mid-January. So yeah, use caution on the S&P 500 right now. Here is a chart of the Nasdaq 100 stock index, and in last week's video we were down back below the prior high of January 26th and the prior high of March 12th. We closed down there, and then as soon as we got through the 4th of July holiday, we exploded back to the upside and retested those prior highs of June 20th and June 14th. And if I draw a resistance line up there, you will see that sure enough, the Nasdaq 100 rallied up there after the 4th of July and hit those two prior highs and then failed on July 11th. So right now we're waiting to see if the Nasdaq 100 is in fact finished with its rally and is beginning to head lower, or if it's going to build up some energy and break free to the upside. Right now it's looking pretty good. The 5-day moving average in red right here is above the 20-day moving average in blue, indicating short-term strength. And the blue 20-day moving average is above the 50-day moving average in purple, indicating intermediate term strength as well. So we have both the short and intermediate term strength indicators, which normally is a very positive scenario. But until this Nasdaq 100 can get above its two June 2018 highs, I would continue to use caution until we get that outcome, because we don't know if it's going to fail yet or not. So use caution until we get a breakout above those June highs on the Nasdaq 100. Moving on to the industry sectors, from now on I'm only going to cover my favorite industry sector and my least favorite industry sector in order to save some time for you on these videos. My favorite industry sector at this time is the S&P 500 Consumer Staples Stock Index. And that's because we had this nice 17.3% decline from the 26th of January all the way down to about the 2nd or 3rd of May. We had a month of sideways movement, and then ever since about June 6th, the consumer staples broke out to the upside, represented by this yellow and red oval. And we've been moving nicely to the upside ever since. So we have the 5-day moving average in red is above the blue 20-day moving average, indicating short-term strength. And the 20-day moving average is in blue is above the purple 50-day moving average, indicating intermediate term strength as well. And the 50-day moving average has started to curve to the upside, which is a very encouraging sight to see. So right now, consumer staples have a lot going for it. It's in a nice uptrend for about a month now, and everything is looking like blue sky at the moment for consumer staples. So I feel really good about this sector, and it's full of companies that make all the stuff that we use on a daily basis, from sodas to juices to toilet paper, paper towels, laundry detergent, you name it. And this is a really solid sector in my opinion. Here's a chart of my least favorite industry sector, and that is the S&P 500 Consumer Discretionary Stock Index. And I say it's my least favorite because it is so incredibly enthusiastic that it is not, in my opinion, a good value at all anymore. You have the 5-day moving average in red is back below the 20-day moving average in blue as of June 27th, which is not a big deal. That just means there's some short-term weakness, but it's turning up again, and that may be the beginning of a rally. But the 20-day moving average in blue is above the purple 50-day moving average, indicating intermediate term strength. What gives me pause with this consumer discretionary, also known as cyclical stock index, is the rate of enthusiasm or rate of change that this is currently undergoing. To really show you that, I'm going to zoom out to a 10-year chart using monthly increments, and we're going to go all the way back here to February of 2009. So what I'm going to show you after I turn off these moving average lines is just the price of this index, and I'm going to show you the rate of change that this index has been undergoing beginning on February 2nd, 2009. We originally had this trend line here that touched this line from September 2011. Then it began to accelerate even faster from September 2011, and we had this line here that touched on October 2016. Then we started to get even more enthusiastic from October 2016 and touching these lows of, looks like September of 2017. So that was that particular line there. And now it's getting even more parabolic, and I should have used that word already. This thing is going parabolic. From September 2017, connecting that line with the low of, let's see what date that is, right here, March 2018, we have that line now, and now it's even pulling away from that. So what we're representing by these red lines here is that this particular index is accelerating faster and faster and beginning to go parabolic to the upside, which it already did back in January, which was this peak right here. It went parabolic from September 2017 to January 2018 and then fell very hard, and now it's accelerating again to the upside. And if this particular index were to fail, then it will fail quite spectacularly because of the amount of change it has made. In fact, this index in 2009 was at 141 points, and it's currently at 870. So that gives you a sense of how many multiples of percentages this particular index has risen since the lows of 2009. So I give you a warning of caution regarding cyclicals and discretionary. This thing looks good at first glance, but the amount of enthusiasm in this particular index is extremely concerning. So be careful, be cautious, and that is my least favorite sector at this time. Thank you again for watching this market update. Before you go, please do me a favor and click the subscribe button on this YouTube channel, and then click the little bell next to it so you'll be notified whenever additional videos are posted. And you'll also find in the top right hand corner of christensenwealth.com and in the summary description of this video on YouTube, you will find links to the Facebook, LinkedIn, and Twitter pages for Christensen Wealth Management. Please visit those when you have time if you use them, and then click the like or follow button while you are there. That way I can communicate with you throughout the week using these videos and on social media. Well, have a great day, and remember, I would say the key takeaway for this week is to remain cautious. We still have some weakness here in these markets and some instability, I guess you could say. I look forward to seeing you again in about another 7 days, and have a great week. Bye-bye.